Something's shifting under the surface of the market, and it's the kind of quiet you notice only if you stop listening to the headlines and start reading the footprints left in the filing. The noise on TV says everything's normal, but backstage, the people who've made fortunes by seeing what others missed are quietly changing their position. It's the little things that matter. Entire stakes sold out in a single quarter, cash balances ballooning to record highs, and allocations collapsing into a handful of names while the rest of the market keeps sprinting like nothing's wrong. That combination is never a coincidence. It's a pattern, and patterns repeat. The question is whether you want to be the person who notices the pattern or the person paying the price when it snaps. There's one investor whose recent moves should make anybody who owns a portfolio sit up. He doesn't shout on TV, he doesn't do hot takes on social, and he rarely posts a press release. He studies the fine print, reads the footnotes, and makes decisions that feel extreme only until they prove painfully prescient. That same temperament is exactly why people who dismissed him in 2006 to 2007 now have a much different tone when his name appeared. He saw the housing market's rotten foundation before the rest of the world, and when he acted, the results weren't pretty for everyone else. Today, he's made another radical change, not screaming sell everything, but selling almost everything he holds in public equities and parking the proceeds somewhere safe until the air clears. Look at his most recent 13F filing and you see it in black and white. A clean sweep. Holdings that were once core have vanished. Chinese tech names, healthcare positions, retail bets, all gone. Those filings even show the scale. Hundreds of thousands of shares unloaded in single names. 300,000 shares of JD.com, 150,000 shares of Alibaba, large blocks of VF Corp and other names, the kind of numbers that aren't subtle. Then, with the proceeds, he consolidated his public holdings into a single beaten-down blue chip, while most of the fund's capital sits in cash, options, or private assets that don't appear in the 13F. That's liquidity and flexibility, not a big directional bet. Why should any of this matter to you? Because the same combination of market conditions that produced the last lost decade, stretched valuations, rampant leverage, and a rush into momentum trades, is echoing in different corners of the market today. Look at valuation metrics that smooth out the noise over 10 years. The CAPE ratio, the cyclically adjusted price-to-earnings measure, is sitting well above its long-term mean, in the high 30s, roughly double the historical average. Historically, CAPE extremes have often foreshadowed difficult stretches. The late 1990s and the lead up to 2008 are textbook examples. High CAPE doesn't guarantee a crash, but it does mean prices assume near-perfect outcomes, and when reality deviates, someone pays the bill. It's tempting to assume that the worst case is another sudden 2008-style implosion, but the more realistic and arguably more dangerous scenario is the slow grind. A market that meanders for a decade, delivering low or negative real returns while inflation erodes purchasing power and opportunity costs pile up. That kind of market is insidious because it doesn't trigger a mass panic overnight. Instead, it steals value quietly. People watch their portfolios drift sideways while they keep paying bills, tuition, and mortgage interest, all the while thinking they're fine because the market always recovered. But recovery takes time, and time can be painfully expensive when compounding works against you. This isn't doomsaying. It's pattern recognition. The moves we're seeing from smart, patient capital are defensive. Cash built up to record levels at Berkshire Hathaway, hundreds of billions on the sideline, institutions piling into short-term treasuries, and managers rebalancing into dividend-rich, cash flow-positive businesses rather than pre-earnings growth story. Warren Buffett's company is holding an unprecedented cash cushion right now, a clear signal when a value-oriented investor of his caliber chooses patience over buying at any price. Ray Dalio, too, has been vocal about systemic risks building beneath the surface. These aren't pundits chasing clicks. They're people who built fortunes by surviving cycles. When investors like this shift into liquidity and quality, it's because their models are telling them the margin for error is smaller than usual. If you're trying to translate those moves into practical steps, start with the basics. Do you have a cash buffer that lets you sleep without checking your portfolio at midnight? Can you survive a 10 or 20% drawdown without liquidating at the worst time? Are you invested in businesses that can tolerate revenue hiccups and still generate cash? These are simple, practical questions. The point is not to sprint to cash and live in constant fear. The point is to create optionality so that when markets misprice something real, you're ready to act without panic. A common mistake is to confuse action with preparedness. buying and selling frantically during a dip is not the same as building a durable plan that lets you capitalize on dislocation. The investors who've built wealth over decades are often doing less right now, trimming exposure, extending duration cautiously, and buying protection where it makes sense. That can mean cutting positions that look great on a momentum chart but terrible on a balance sheet, boosting exposure to companies with pricing power and healthy free cash flow, and keeping powder dry for genuine bargain. It's not exciting, but it's effective. Another signal to watch is the credit market. Corporate borrowing costs have shifted, refinancing windows are tightening, and companies that relied on cheap money to grow could face pressure when rates and margins collide. When debt servicing stress rises, the knock-on effects show up first in smaller cap and highly leveraged companies before they ripple outward. That's where you see the structural cracks, not in a single headline, but in a steady increase of downgrades, delayed projects, and cautious CFO commentary. The broader market can look resilient even as the scaffolding underneath begins to wobble. You don't have to predict the exact date of a downturn to benefit from caution. Positioning for durability means trading some long-term upside for reduced vulnerability. That often looks like favoring companies with strong balance sheets, recurring revenue, and the ability to raise prices when costs increase. It also means paying attention to where institutional capital is moving. When you see cash piles at conglomerates, rising allocations to high-quality fixed income, and lower exposure to frothy sectors, treat those as directional signals. Smart capital is prioritizing preservation right now. It's worth remembering that no investor is always right. Even the people we respect for spotting the big trends have calls that fail. The value in watching their moves isn't to copy blindly, but to understand the rationale and the risk framework behind them. When a proven investor dramatically shifts allocation, they're not issuing a prophecy. They're adjusting the palette of risk they're willing to carry. For everyday investors, that translates into asking tougher questions about what you own and why. Does this business have staying power? Is the valuation reasonable? Could this position survive a prolonged period of slow growth? Practical steps you can take today are straightforward. Shore up your emergency cash, reduce exposure to speculative, highly leveraged bets, and increase allocation to high-quality names that can generate free cash flow in almost any environment. Consider dollar-cost averaging into high-quality assets rather than lump sum chasing the hottest theme. Refinance or pay down high-interest consumer debt aggressively. That step alone is one of the most immediate ways to improve financial resilience. And remember, your skills and earning power are your greatest financial leverage. Investing in your ability to earn more or reduce expenses compounds just like a market investment. At the heart of this shift is patience and discipline. When markets reward speculation, it's easy to feel left behind if you don't chase every breakout. But the most reliable path to long-term success is often boring. Consistent savings, sound diversification, and an awareness of the macro backdrop that might make the next decade harder than the last. We aren't predicting doom. We're advocating prudence. If the market gives you a decade of sideways returns, you'll be glad you prepared. If it rallies and proves the skeptics wrong, preparedness still wins because you'll capture growth without being forced to sell at an inopportune time. So take this as both a warning and a call to action. Watch what the seasoned investors are doing, not to mimic their trades blindly, but to understand the mindset of preservation over speculation. Build your portfolio for durability, have cash ready to act when real opportunities appear, and focus on companies whose fundamentals make sense in every kind of economy.